Great news for some, not so great for others. Employment rates are up. Great, more people getting jobs. However, not such great news for anyone who's looking for interest rates to go down. Here's why. The Bank of Canada is looking to increase interest rates and lower the amount of jobs. And before you think of them as the bad guys, just hold on. Raising the interest rates in this scenario and lowering the amount of jobs will actually balance inflation a lot better. Most of the time, inflation is caused by too much money in the economy. Central banks try and solve this problem by raising interest rates. Raising interest rates makes borrowing money more expensive and increases returns on savings. This causes consumers and businesses to pause their spending and borrow less. As a result, there's less money moving around in the economy and inflation decreases, which is what the Bank of Canada's goal is. However, the Government of Canada and the Bank of Canada are not working hand in hand, and they obviously have some kind of different goals going on there. The government is spending way too much, and the Bank of Canada is trying their best to regulate that and make sure that the consumers don't see as hard of a hit. The Bank of Canada is trying to adjust the rates of interest so that it discourages the government from spending as much, trying to ensure that they don't overspend. But too late. We obviously as consumers get directly impacted by this rat race of a cycle. Interest rates have been historically low since the financial crisis in 2008. This enabled families in Canada to borrow way more than they were earning. Before 2008, the average household owed $1.49 for every dollar of income earned in personal debt. By the end of 2021, it had risen to $1.79. Today we sit at $1.84 of personal debt per dollar of income made as Canadians. And this doesn't even include business debt. Making borrowing more expensive will make it very difficult for consumers and businesses to refinance debt or qualify for mortgages. That's why now than ever, it's more important for people to understand real estate and real estate investing strategies, to get into the marketplace and to be able to still continue to build wealth through real estate. As we said, higher interest rates tend to lower consumer spending. This leads to a reduction in hiring and less jobs available in the marketplace. We've seen this happen a couple months ago with the mass layoffs that were happening. So as we know now, when interest rates rise, it's often because of overspending. It happens for two reasons. First, as we know, higher interest rates make it more expensive to borrow money. Second, it alerts that the central banks might think that increased government spending could result in the economy to grow way too fast, promoting, of course, the central banks to increase interest rates to promote the reverse effect. Perfect example of this with the increase of immigration and not enough housing and supply. These all go hand in hand. Even though government revenues tend to grow with inflation, especially if there's additional taxes in place, this will not necessarily translate to an increase in wages in the public sector. If the Bank of Canada continues to increase interest rates, it's to quiet fears of runaway government spending and inflation instead of as a result of excess money in the economy, because we all know we all got none of that. All these impacts will be intensified as we have experienced and will continue to experience for the next little bit. So everyone just hunker down and buckle up. What are your thoughts on what's next? Will we see another interest rate hike before 2024? Let us know in the comments and be sure to see our predictions on what's next. Make sure to follow us for all your Canadian real estate investing tips and tricks and to build wealth with each and every real estate transaction despite whatever the market conditions are.